Hello my friends and welcome back to my channel. We back in Lviv region, Ukraine, and today we're gonna learn English as well as accounting by learning financial accounting together with you, my friends. And we'll start with income statement. And as you can see, income statement summarizes a firm's revenue and expenses for a period of time. Net income is computed by subtracting expenses from revenues. G and T's income statement for the month of January appears in Exhibit 2.9. The income statement is prepared by compiling information from the owner's equity account. So what we're gonna do, we're gonna take owner's equity account and we'll compile all the information, and based on it we'll prepare income statement. Recall that all revenue transactions increase owner's equity. And that all expense transactions reduce owner's equity. This makes owner's equity a convenient place to look for information about revenues and expenses. So one more time, we'll take all the information from owner's equity account, and based on it we'll prepare income statement. And as you probably know that, as it said here, quote, all revenue transactions increased owner's equity, and that all expenses transactions reduce owner's equity. Income statement equity. This makes owner's equity a convenient place to look for information about revenue and expenses. And as that happens just because, as we said, we see here that all revenue transaction increase while expense transactions reduce owner's equity. To help you see that J and T's income statement summarizes its revenue and expenses transactions for the month of January, Exhibit 2.10 summarizes all of the J, G, and T transactions for that month. An alternative method that can be used to prepare the income statement is to examine assets and liabilities. So, as we said before, there are a way of doing it by examining owner's equity account and understanding and realizing that all of the increases go to the income, and all of the expenses will go to all the reductions. Expense transactions will be reducing owner equity, while all revenue transactions will increase owner's equity. Hence, this method is different, and for example, some revenue transactions affect cash, other revenue transactions affect account receivable, and still others affect unearned revenue. That the information about revenue transactions appears in a variety of assets and liability accounts. Moreover, many non-revenue transactions affect assets and liabilities, complicating the identification of revenue transactions. An easy approach is simply to examine Examine owner's equity. A similar argument can be made for expenses. Care must be taken, however, not to include in the income statement all transactions that affect owner's equity. Direct contributions by owners increase owner's equity, but they do not constitute revenue. Similarly, withdrawals by owners reduce owners' equity, but they are not viewed as expenses. So my friends, we have to be careful not to include in income statement all transactions that affect owners' equity. Direct contributions by owners increase owners' equity, but they do not constitute revenue. Similarly, withdrawals by owners reduce owners' equity, but they are not viewed as expenses. The income statement provides financial statement readers with information about the profitability of the organization for a past period of time. It indicates how successful the organization was in generating revenue and controlling costs. During January, G&T earned a net income of 289 income. Also, this amount might not seem very impressive in light of total revenue of 4,650 and an investment of 50,000 by Harry. January was G&T's first month of operation. Simply operating above break-even, a zero profit or loss, is an accomplishment. And if we will look into it as a large corporation, then income statement can be also looked at as report of management performance. One of management's major responsibilities is to enhance shareholder wealth. Managers serve as an agent of the shareholders. They must be held accountable for their performance. Of course, profitable operations are essential to adding value to the firm. The income statement can be used to assess how well managers have performed.